I want you to imagine something for a moment. You wake up tomorrow morning and check your bank account. The app will not load. You try the website, nothing. You drive to your local branch, and there is a sign on the door, closed until further notice. Your life savings are inside that building, and you cannot touch them. You think this cannot happen in Canada, right? We have the big 5 banks. We have regulations. We have deposit insurance. Everything is safe. That is what they want you to believe. But here is what they do not tell you. Canadian deposit insurance has limits that most people do not understand. There are entire categories of money that are not protected at all. And the system that is supposed to keep your money safe has never been tested against a real crisis. Today, I am going to show you exactly what is covered and what is not. And by the end of this video, you might want to make some phone calls. Welcome to Canada Insider. I am Daniel. Today we are going to have a conversation that your bank does not want you to have. We are going to talk about what happens if things go wrong. I am going to show you 5 things that every Canadian with money in the bank needs to understand. First, the CDIC protection limits and why $100,000 does not mean what you think it means. Second, the categories of money that have zero protection, even at major banks. Third, the exposure Canadian banks have to the housing market and why that should concern you. Fourth, the warning signs that something might be going wrong. And fifth, the protection playbook, with steps you can take this week to secure your savings. This is not about fear. This is about information. And information is power. If you are not subscribed to Canada Insider, hit that button now, because what I am about to share could protect everything you have worked your entire life to build. Let us get into it. Let me start with something most Canadians think they understand, but actually do not. CDIC, the Canada Deposit Insurance Corporation. This is the government agency that protects your deposits if your bank fails. You have probably seen the little sticker at your bank branch. Member of CDIC, deposits insured up to $100,000. Sounds simple, right? It is not. Here is the first thing you need to know. That $100,000 limit is per depositor per category at each member institution. What does per category mean? CDIC has 7 separate categories. Deposits in your name, joint deposits, RRSP deposits, RRIF deposits, TFSA deposits, trust deposits, and deposits held for paying taxes on mortgaged properties. Now here's where it gets complicated. Each category has its own $100,000 limit. So theoretically, if you structured your money perfectly across all categories at one bank, you could have up to $700,000 protected. But here is the catch. Most people do not have 7 categories. Most people have their savings account, and maybe a TFSA, and maybe an RRSP. That is 3 categories. And if any single category exceeds $100,000, the excess is not protected. I spoke to a retired accountant who spent 40 years advising clients on financial matters. Even she was confused by the rules. She told me, Daniel, I had to read the CDIC website 3 times to understand how my own money was covered. If a professional accountant struggles with this, imagine what regular Canadians are dealing with. Now pay attention to this next part, because this is where people get hurt. There are entire categories of money that CDIC does not cover at all. Not partially, not with limits, zero protection. And these are categories where many Canadians have significant savings. First, stocks, bonds, and mutual funds. If you have investments at your bank, they are not covered by CDIC. Even if you bought them through your bank's investment arm, even if they show up on the same statement as your savings account, not covered. Second, money in foreign currencies. If you have a US dollar account at your Canadian bank, it is not covered. That US dollar savings account you opened for travel or cross-border shopping, not protected. Third, GICs and term deposits with terms longer than 5 years. Most people do not know this one. If your GIC has a term longer than 5 years, it falls outside CDIC coverage. Some banks offer 7 or 10-year GICs, not covered. Fourth, cryptocurrency held at banks or through bank platforms, not covered. not even a little bit. Fifth, and this is a big one, any deposits at institutions that are not CDIC members. Credit unions in most provinces are covered by provincial deposit insurance, not CDIC. The rules and limits are different. Some trust companies are not members at all. I talked to a financial advisor in Calgary who told me a story that should scare you. He had a client who retired with $800,000. She put it all in one savings account at her bank because she trusted them, and she did not want the complexity of managing multiple accounts. She thought CDIC covered everything because she saw the sticker. She had no idea that $700,000 of her money was completely unprotected. If that bank had failed, she would have gotten $100,000 back and lost everything else. Here is where it gets interesting. Let us talk about why this matters right now. Canadian banks have something in common that makes them different from banks in most other developed countries. They are massively exposed to residential real estate, exposed in a way that would make regulators in other countries very nervous. The Big Five Canadian banks hold over $1.5 trillion in residential mortgages. To put that in perspective, that is roughly 50% of Canada's entire GDP tied up in home loans held by just 5 institutions. Now think about what we discussed in previous videos. Housing prices that have dropped 15 to 25% in many markets. Hundreds of thousands of homeowners facing payment shock. Rising delinquencies. Rising insolvencies. If housing prices continue to fall and mortgage defaults start to spike, the banks holding those mortgages feel the pain. Now, I am not saying Canadian banks are about to collapse. They are well capitalized by regulatory standards. They have stress tested against various scenarios. But here is the thing about stress tests. They test against scenarios that regulators imagine. They cannot test against scenarios nobody has imagined yet. In 2007, American banks were also well capitalized by regulatory standards. They had also passed their stress tests, and we all know what happened next. The scenario that actually unfolded was worse than anything the models had predicted. I am not saying Canada is America. Our banking system is structured differently. Our mortgage market works differently. But the lesson from 2008 is clear. When everyone tells you the banks are safe, that is precisely when you should be asking questions. Now connect the dots with me, because this next part is important. You might be thinking, okay, and if a bank got into trouble, the government would step in, right? They would not let a major bank fail. The economy depends on it. This is the too big to fail assumption, and it is dangerous. Yes, the government probably would intervene to prevent a major bank from collapsing entirely. But here is what too big to fail actually means in practice. It does not mean depositors get made whole. It does not mean shareholders are protected. It does not mean everything goes back to normal with no pain. Look at what happened during bank failures in other countries. Cyprus, in 2013, depositors with more than 100,000 euros had their accounts frozen. Then, they had up to 40% of their uninsured deposits converted to bank shares that were essentially worthless. The banks did not fail completely, but people lost huge portions of their savings anyway. In Canada, there is actually a legal framework for this. It is called the bail-in regime. If a major bank gets into serious trouble, regulators have the power to convert certain deposits and debt instruments into shares of the bank. Your money becomes equity in a failing institution. Now, CDIC insured deposits are supposed to be protected from bail-in. But here is the question. If you have $300,000 in a savings account and only $100,000 is insured, what happens to the other $200,000 in a bail-in scenario? The rules are complicated, and the honest answer is nobody knows for certain because it has never been tested. This is the too big to fail myth. The government will probably save the institution, but saving the institution is not the same as saving your money. This brings us to something practical. How do you know if trouble is brewing? What are the warning signs that something might be going wrong at a financial institution before it becomes a crisis? Let me give you the signals that people who watch this industry look for. First, unusual rate offers. If a bank or credit union is suddenly offering savings rates or GIC rates significantly higher than competitors, ask why. They might be desperate for deposits to shore up their balance sheet. High rates are great until you realize they were a distress signal. Second, executive departures. When multiple senior executives leave a financial institution in a short period, that can indicate internal problems that are not yet public. Pay attention to news about your bank's leadership. Third, credit rating changes. Banks have credit ratings just like governments and corporations. If a rating agency downgrades your bank or puts it on negative watch, that is a signal worth paying attention to. You can look up credit ratings online for any major institution. Fourth, stock price collapse. If you bank with one of the publicly traded banks, watch their stock price. A sudden, significant drop often means investors know something the public does not yet. Stock prices can be early warning systems. Fifth, regulatory actions. If you hear that regulators have issued warnings or taken enforcement actions against an institution, that is a red flag. These actions are usually public record if you know where to look. Sixth, and this is subtle, changes to account terms. If your bank suddenly changes withdrawal limits or imposes new fees or makes it harder to move money out, those could be signs of liquidity stress. Banks that need to hold on to deposits sometimes make it inconvenient to leave. None of these signals alone means disaster is imminent, but multiple signals appearing together should make you pay closer attention. But here is the good news. You are watching this video, which means you are ahead of most Canadians who have never thought about any of this. Being informed is the first step to being protected. Preparation is the opposite of panic. Let me give you the protection playbook with concrete steps you can take starting this week. Step 1. Know exactly what you have and where. Make a list of every account at every institution. Include the account type and the balance. Do not guess. Log in and check the actual numbers. Step 2. Understand your CDIC coverage. Go to the CDIC website. They have a tool that helps you calculate your coverage based on your specific accounts. Use it. Know precisely how much of your money is insured and how much is not. Step 3. Spread your deposits across multiple institutions. If you have $300,000 in savings, consider splitting it between 3 different CDIC member banks. Each bank covers you separately up to the category limits. This is the simplest way to increase your protection. Step 4. If you use a credit union, verify their deposit insurance. Provincial deposit insurance varies. Some provinces offer unlimited coverage. Others have limits. Know what applies to your credit union. Step 5. Consider what you hold in registered accounts versus non-registered. RRSP and TFSA and RIF each have separate CDIC coverage. Structuring your money strategically across account types can increase your total protection. Step 6. Keep some accessible liquidity outside the banking system. This does not mean stuffing cash in your mattress, but having some funds in a money market ETF in a brokerage account or in provincial savings bonds provides diversification away from bank deposits. Step 7. Review your coverage annually. As your savings grow, your protection gaps grow too. $100,000 in coverage felt like plenty when you had $50,000 in the bank. It feels very different when you have $500,000. If this video opened your eyes to something you did not know, share it with someone who needs to see it. A parent with their life savings at one bank. A friend who thinks everything is automatically protected. Anyone who deserves to know the real rules. Subscribe to Canada Insider and hit the notification bell, because the next video could reveal something equally important about your financial security. Before I close, I want to address something uncomfortable. Some people will watch this video and say, "Daniel, you are fear-mongering. Canadian banks are among the safest in the world. Nothing bad is going to happen." And they might be right. But here is my question for those people. What is the downside of being informed? What is the cost of understanding how deposit insurance actually works? What do you lose by spreading your savings across multiple institutions just in case? The answer is nothing. You lose nothing by being prepared. But the potential cost of not being prepared is everything you have saved. I am not telling you to panic. I am not telling you to pull all your money out of banks. I am telling you to understand the system you are trusting with your life savings. I am telling you to verify rather than assume. I am telling you to take the same approach to your money that you would take to any other major risk in your life. You have insurance on your house, even though you do not expect it to burn down. You have insurance on your car, even though you do not plan to crash. Why would you not structure your savings to be protected, even though you do not expect your bank to fail? The Canadian banking system has been stable for a long time, but stable does not mean invincible. And the best time to prepare for a problem is before the problem arrives. Let me leave you with this. Your money represents something more than numbers on a screen. It represents decades of work, sacrifices you made, opportunities you gave up, time you will never get back. You earned that money, and you deserve to know exactly how protected it is. The system wants you to trust without verifying. They want you to see that CDIC sticker and feel safe without asking any questions. They want you to assume that someone else is looking out for you. But nobody is looking out for your money the way you will look out for your money. Take an hour this week. Make the list of your accounts. Check your coverage. Look at whether you are concentrated in one institution or spread across several. Have the conversation with your spouse or your financial advisor about whether your current structure makes sense. This is not about fear. This is about responsibility. You work too hard and too long to leave your financial security to assumptions and hope. The people who get hurt in financial crises are not the people who prepared. They are the people who thought it could never happen to them. Do not be one of those people. I am Daniel. This is Canada Insider, and I will see you in the next one.